My name is Michael Guyett, publisher of the Lead Lag Report. Joining us for the hour here, Harris Kupperman, who's built quite a name in FinTwit world and has a lot of great thoughts on what's happening in the energy space and how to think about uranium here. But Harris, for those who are not familiar with your background, just talk about who you are, how'd you get involved in markets, and what are you doing now?
Sure. Hey, everybody. I think most of you guys know who I am, but I've been investing in markets since the late '90s when I was in boarding school and I should have been going to class, and instead I'd stay in the dorm and trade stocks. And I currently run Praetorian Capital. It's a hedge fund. It's our fourth year in operation. We have about 180 million of assets. We've put up some pretty strong numbers, in terms of my worldview. And even this year, when I think a lot of guys are having a rough year, we're slightly up on the air. So, it's kind of quick background on who I am and what I do.
All right, let's talk about the mindset that goes into your portfolio construction. You're managing a hedge fund. Hedge funds for the last decade plus haven't really been all that interesting. You've seen all the data around alpha being essentially negative for kind of the vast majority of different funds. Talk about your process. How do you go about selecting and positioning?
So I think one of the reasons that a lot of funds have really suffered is they got too big, and they got to the point where they had to choose 100 names in the S&P, and they have this mindset that they have to run a book that's like 150-50, so they're 100 net, but they have these shorts, and they usually short the stuff that is going up, and they usually long the stuff that isn't. They tend to be in the same names that all their friends are in, and you end up with these hedge fund hotel disasters. When they miss earnings, they just cascade. I just think that the whole industry has been bastardized. It's become about asset gathering as opposed to making money, and it's really not serving anyone except the portfolio managers. In terms of what we do, I think we do something very different. I think of myself in really two buckets. I'm an inflection investor foremost. We look for sectors and themes that are inflecting, quote unquote. These are sectors usually that are unloved, underappreciated, ignored, not followed, often beaten down because they've really disappointed people for many years. And we're trying to find a catalyst or an event or something that unlocks the value and can put the business on a different trajectory. We're usually looking at cyclical businesses, commodity stuff, secular change in industry. We also have a really deep event-driven backdrop to what we do, where we run a service, and I'll talk about it later, called Kedem, but we're tracking over 20 event-driven strategies, and a lot of those strategies can unlock some sort of inflection. There's the cap structure stuff like spin-off, privatization, demutualization, buybacks, dividends, all that sort of stuff. But then you have the more interesting ones, which are like CEO change, where you have a business that was mismanaged, and a new guy with fresh eyes comes in, and you could have a dramatic inflection in the business. And so, kind of taking it back to your question, we're looking for inflections, and we're trying to buy stuff that is mispriced, and we're usually buying stuff at single-digit multiples on next year's earnings or huge discounts to replacement costs. I find that Wall Street is really good at taking something like Google that grows and just extrapolating the growth forward. And Wall Street's really terrible at taking something that's been pretty terrible for a long time and looking around the corner and believing that things can get better.
So on that inflection point, there's two things that can have an inflection, right? One is the macro environment, and then two is the idiosyncratic, something specific to the company. It sounds to me, correct me if I'm wrong, that you're focused more on company specific catalysts as opposed to necessarily taking a world view on something.
I think we do both. I don't usually talk about the individual stocks that are having, a change because the new CEO is coming in, or, they've reinvented the product, or they changed how they market the product, because they're just not very interesting stories to talk about. I mean, in the end, no one wants to hear about a 3% position I have that I have a unique take on. They probably never even heard of the company because it's a $200 million company, and compliance doesn't want me talking about those. So instead, I usually defer to talking about oil and uranium and housing and all these other trends that are big macro trends where you can look at it top down and then find tons of different ways to play it. But even the bottom up stuff I do, it all has a macro tailwind. I'm not going to be going into a sector that's hurting and trying to choose, a company that's going to outperform, because you're just not going to make any money.
Yeah, and it's good to have obviously the macro tailwind because it's a lot easier to undo mistakes when you have the broader trend in your favor for that school of fish. But are you based on that? Are you looking at portfolio construction more from always having a long bias? Are you doing anything directional to broader beta? I'm trying to get into sort of the mechanics. I think that will relate nicely to sort of where we are this year.
So I don't short much. I mean, I'm a hedge fund. I'm allowed to short. I just don't do it much. I don't really think in terms of beta. I just think in terms of how do I construct a portfolio where each position is non-correlated, and if I get an idea wrong, how do I get my money back? And sometimes you really get it wrong, and you still get your money back. And how do I get it right and get a 5 or 10 bagger? I don't put anything on the book that's not at least a triple in 3 years. And really, my cutoff's a 5 bagger in 3 years. I want something that really, if it works, it's going to work. And I try to do this without taking on financial leverage. It's all operating leverage. And the fact that Wall Street, for better or worse, doesn't really work on valuation. It works on themes. And so you need something that'll capture people's imagination in terms of a thematic that they can look at and say, yeah, I get it. You've just put together 2 good years. I can now extrapolate another decade of that, those sort of numbers. And then let's discount it back. And, wow, this thing's a 10 bagger. That's kind of how I'm thinking of the world. And, it's one of the reasons I've kind of avoided some of the stuff I've avoided just because I never thought Wall Street would get its brain around it. It's something like coal. We made a lot of money in coal early on, but we tossed it early because the easiest money was when it went from almost bankrupt to going to make it. And then from there, Wall Street just never was going to put a multiple on it. So we had a lot of multi-baggers, but we didn't stick around because it just wouldn't get the multiple. It's partly just seeing where people will be willing to invest. I mean, multiple expansion is usually what drives stock price. It's not usually driven by earnings. I mean, I guess earnings can expand dramatically, especially if a company is under earning. But there's kind of a ceiling to how much a company can earn based on the revenue.
I love that line that Wall Street favors themes, not fundamentals. I mean, I have seen that obviously for a number of years as well as somebody who launches ETFs and works with a company that helps to white label some of this stuff. Now, I named this space oil is about to explode, which sounds really, really dramatic. But that's because you and I were coordinating on the DM side. I've had a lot of people talk about oil the last several months. I just had Stephen Shork yesterday talk about oil. I think everyone's largely in agreement that you have a real secular tailwind when it comes to oil because of underinvestment. But I think what's not clear is upside potential. So I want you to talk about your thesis around the energy space and why a lot more could be coming in terms of oil prices, and of course why it's so critical to the market.
So, I found that when it comes to commodities, you have this weird clustering, like, two standard deviations from the 3 month, average volatility of something. So when oil was at 60, all the Wall Street analysts had price targets for year end of between 50 and 70. And then when oil was 80, everyone had price targets between 65 and 85, and then, 95. It's kind of funny. And, right now oil's 110, let's say, and everyone has a price target between 100 and 125. They just kind of like group themselves around the target. And I think they totally missed the whole point of this. We've had since 2014 a dramatic underinvestment in long cycle energy. And these are projects that take a long time to get online. And then they decay a few percent a year, 5, 6, 7, 10%, whatever. But they're all starting to trail off, and there's not been much investment in that. What we have had investment in is short cycle, that's shale. And shale will grow from here again. I don't think it'll hit a new high, though. And you have government and ESG that are standing in the way of this. And I think this has all been done to death. I mean, if you follow my Twitter stream, you know where I stand. But you have Biden going around canceling pipelines and drilling permits, and you have banks that refuse to lend. So these companies have to use internally generated cash flow. And if you look at oil production, the cash flow cycle is kind of funny. It all gets tied up in working capital. It all gets tied up in downhole. It takes a long time before you've recovered all your capital from a well. And so it just means that the pace of recovery and the pace of production growth is going to be limited to cash flow because the banks won't lend. Or if they will lend, the terms aren't very generous. And, no one wants to have to force to, lock in their future production at $80 down the curve 2 years or whatever it is. So I just think it's going to come back slow. Meanwhile, and I think people really forget this. I spent 10 years of my life living in an emerging market, and I saw the emerging market have an economic crisis that lasted a decade. And the per capita GDP is probably down more than half since I moved to that country. And oil consumption grew every year. And I think people forget that there's 6 billion people that want the same standard of living that we have here in the West. And a lot of these people don't have refrigerators or televisions or dishwashers or cars, obviously, or air conditioning, and energy consumption in all its various forms will grow on a per capita basis almost indefinitely for the rest of my lifetime, unless the population of the world shrinks dramatically, and technology won't be able to overcome this. And so, you have a couple of core sources of energy, and one of them is going to be oil, and that's the one that really does have the most deficit right now. And that's the one that I think is about to blow out to the upside in a very dramatic way. And people keep thinking, oh, it goes to 125 and it's done, or maybe it goes to 150 like 2008, and then the global economy collapses and it's at 50 6 months later. And I think that's just the wrong mental model to use. I think the more likely outcome is it blows off to some ridiculous number that all of us think is impossible, like call it 500 or something. And that's not my prediction. That's just a ridiculous number that I don't think is possible, but might be possible. And then I think it collapses down to some number like 150 to 200. And that's the new level, because when you have this much underinvestment, you have this much growth, and I think demand's going to keep growing 1 to 3 million barrels a year, and the supply is going to keep lagging, and you're going to keep draining inventory. And when you drain inventory, you have less flexibility to counter these price spikes, and you're always one international incident away from a $200 price spike, which is going to force a risk premium into all this stuff. And no, I think it's going to absolutely blow out. I mean, I find it hilarious that a good chunk of the financial community is focused on what the Federal Reserve says next, or where interest rates go, or Apple's earnings, or whatever dumb thing they're focused on. I mean, the only thing people should be focused on is the price of oil and how high it spikes when it spikes. Because if it does get to 500, I mean, all the other Q-sips go to zero, and I think that's really the thing that people should be fixated on here.
But in order to have that let's call it super spike, that tail, you need some kind of events, and as you alluded to, right, it's probably going to be more on the geopolitical front, but arguably there is also a chance it goes the other way in terms of not a spike, obviously, but a collapse if somehow magically we get a ceasefire or something when it comes to Russia Ukraine, at least for a moment in time, right? So how do you think about balancing tail risks, because it seems like there's potentially another negative surprise out there, right, on the geopolitical front, but we can still have positive surprises that brings oil down.
So, I mean, I don't really try to think of this, what happens next week, or what's Putin's next move, or what Xi's going to do, or, what Biden's going to do. I think even if there's a ceasefire in Russia, in the end, Russia's exporting all they can. I don't think it changes anything. Could oil drop $20 that day? Yeah, sure, whatever. But I don't think it changes anything, the supply demand balances. I mean, for my entire professional career, it's always been demand side question in terms of oil. And for the first time, it's a supply side question in terms of oil. And that's a very different dynamic than anyone's really dealt with since the 70s in terms of what the oil price will be. And so I don't think that what happens in terms of GDP or what happens, in consumption, like, I don't think that's going to move the needle as much as people think, especially because we've seen every government around the world handing out stimmies. And if you hand out stimmies, consumption, stays constant or goes up. I think we're in a new world where if oil's at 200, demand actually increases. Because if the government gives me 50 free gallons a month and I don't use 50, I really don't, I'm going to hand that card to one of my friends that might need it. And so, you'll have net consumption increase. And you'll see this in rich countries. You'll see this in poor countries. Everyone's going to hand out stimmies. And at the same time, they're going to go around whack-a-mole, making it impossible to drill for oil. I mean, they've been talking about excess profits taxes, and they've been talking about carbon taxes, and various countries have already implemented some of these things, and they're going to continue to implement these things because it's popular with voters. But the net result is that you don't see much production. And, the really scary one's the N word. And I think there's a pretty good chance that they start talking about nationalization. And, at that point, all bets are off. No one's putting a dollar into the ground. And so, no, I just don't think there's any supply response. They've taken the law of economics where the price goes up, usually demand declines and supply increases, and they've kind of flipped it. I don't think people have realized that governments have intervened in the economic cycle and flipped it. And I think it's going to take a long time for people to realize just how dramatic that flipping has been. So I'm not really focused on what happens with a ceasefire or what happens each data point. I mean, if we keep drawing down the U.S. 7 to 10 million barrels a week, like we have been, I mean, there's going to be a crisis. It's inevitable, and I think you're going to see this, throughout the world.
Yeah, and I love that tweet I shared at the top here that you put out. You and I both share a degree of sarcasm with content, but you're saying China's draining our SPR. Talk about that for a bit, because I think it's amazing how the response doesn't seem to be mattering, nor is it logical in the context of everybody wanting oil.
Sorry, you can explain it again. I mean, the response.
Just the link between China. Why is that point you mentioned? Why is China? China's draining our SPR. How is China actually doing that? Explain that link.
Oh, because we have fuckwits running our country.
That's what I was looking for. It's for fun. Yeah, let's get fired up, Harris. Come on.
I mean, look, if the price of oil goes to $500, it's not going to really change my life. I mean, I'm a successful hedge fund manager. I'll just pay more for gas, and I'm long a bunch of oil, and net is probably a positive. But well, it's going to be a positive. But in terms, the rest of our country, it's going to be pretty terrible for them. It's going to be a giant tax on the middle class, and I think it's gonna. You ever see the movie There'll Be Blood, where I drink your milkshake?
Yep.
Well, I feel like oil is I drink your milkshake, but it's going to be Walmart and Target and all these other guys where the consumers just don't have any money. I mean, they spent all their money to get to Walmart, and then they have no money left over to buy anything there.
I think that's also where Brent Johnson gets his dollar milkshake theory. I think same part of that. Okay, now I had Kevin Bambro on several months ago, and he's big on uranium and makes a very compelling case that if you really want to play the EV super trends, you really want to play oil, you have to think about the secondary and tertiary beneficiaries, and his argument is that nuclear is really the only way. So I want you to lay out your thesis on the uranium space, and maybe why it hasn't really panned out as well as people hoped. I mean, it's doing okay this year, but let's talk about that for a bit.
Sure. I mean, in terms of uranium, I look at big macro trends. After fighting it really for 4 decades, I think the world's coming around to the conclusion that if you want to have a low carbon intensity baseload power, nuclear is really your only option outside of hydro, and there's only so many rivers you can dam. And so, as a result, I think the world's going to be forced to pivot to nuclear. And there's a lot of people who call themselves green who haven't come to that realization yet, but a lot of pragmatists have. And I think we've seen that cycle. We've seen in the U.S., we've seen multiple reactors that were supposed to be closed. Same within Europe that are now getting a new lease on life, and just because we need the electricity, quite honestly, just pragmatism. You see China and India going crazy building these things. I think it's pretty safe to say that demand's going to increase quite dramatically. At the same time, we've had a really epic bear market in uranium. I mean, it's been 14 years of since the last peak, and a lot of the mines have either gone care and maintenance or gone out of business. And the world right now consumes a lot more than we produce. I think for 2023, give or take 5 million in each direction, we're going to consume about 185 million pounds, and we're going to produce around 150. And there's some questionability about that production number because a lot of it's a byproduct. And we might go from underfeeding to overfeeding in terms of tail, which means that the supply side may drop more, but just hold that 150 constant. And we're about a 35 million pound deficit each year. And, we've been running a similar sort of deficit now for 4 years. And at some point, they'll drain the warehouses. And then the price will have to go to a level where it makes sense for people to restart a bunch of the shuttered mines. I mean, it's kind of one of those inevitable things. If something's unsustainable, it's eventually going to, have an adjustment. And the adjustment is that the price will have to go up, and then the mines will come back on. And normally when you have these rather opaque, thin markets, the price overshoots very dramatically. We saw this the last uranium cycle that I played, and I feel pretty good it'll happen again this cycle. The difference being that we have this entity called Sprott Physical Uranium Trust, or SPUT, and it keeps going out there buying pounds and sequestering them. And if I know anything about bull markets, if uranium starts moving and it makes a new high, above like 62 or so, where it kind of peaked out in Q1, I think a lot of retail traders and wise guys, hedge funds like myself, are gonna buy a bunch more. I mean, well, I have a full position. I won't be buying more, but a bunch of other guys will. And what that'll do is it'll just put more money into the trust, and they'll be chasing the price higher as they buy more pounds. And they'll just make the deficit more extreme and lead to the overshoot being more extreme. And so I have a very large position in this, and I think it's a pretty low risk trade here from the 48, 49 level of physical uranium. And I don't know. I got in at 31. It's been good to me so far. I expected a bit more, but all these things take time.
So that point is interesting about how the ETF could impact the underlying, right? So when GLD came out, there were some on the fringe arguments that as gold momentum picks up, GLD is going to get assets that will then kind of become a self-fulfilling prophecy. But GLD relative to the gold market is nothing. It sounds like if you think about the size of the uranium market, the ETF for uranium, the Sprott fund you mentioned, could have a much bigger impact than other ETF launches around underlying commodities.
Well, I mean, gold dramatically changed the dynamics of the gold market. If you look at when it launched and then look out 2 years, it dramatically adjusted the price. And I've seen this with Sprott. When they announced that they were launching this trust, we bought we bought a few percent of the thing at $31 reference price, and here we are 9 months later, and it's 49. I mean, that's like a 70% return. I've had better trades, I've had worse trades in my career, but it's not so bad given that the overall market's down during that time and down quite a lot. It's already adjusting the price, and I think it'll accelerate it. But Sprott's now sequestered almost 40 million pounds since Sprott took over the vehicle. And so when you look at that in the context of 150 million pounds of production, I mean, you're looking at almost 30% of annual production disappearing. And that's definitely not sustainable. And things that aren't sustainable will eventually, adjust something. And so, yeah, I think it's, since it's so material to the size of the market, it probably will eventually adjust the price, and probably at the extremes, it will dramatically adjust the price as retail comes in and just floods the market.
Presumably, the real catalyst for uranium has to really come from Europe and, in particular, Germany, right? To get nuclear kind of back at the front of the conversation. Is there anything that you're seeing that suggests that there's maybe sort of imminent catalysts like that countries are looking to restart some of their plans from a longer term perspective, counter oil reliance on Russia?
Um, yeah, a bit here and there. I mean, the French have said that they want to build more nuclear power plants. I mean, the Germans are now going to leave their last three plants going. Um, I think when you've polluted people's brains as a politician and lied to people and created a religion around a hoax, it's really hard to then say, yeah, we kind of got that one wrong. And so you're going to need elections and you need new politicians. And that's why these things always take time. And that's why when the cycles swing, they tend to overshoot dramatically in both directions. And so I think it's just going to take time, but I don't think the uranium thesis is really based on any individual reactor staying on or getting shut. And quite honestly, it takes a decade to build a reactor. It's that's not really within my investment timeline. My investment timeline is really predicated on the idea that if you consume 35 million pounds more than you produce each year, and then you have a sput out there on the periphery consuming pounds, and you have other entities like Yellowcake consuming pounds, and you have utilities that have drawn down inventory that might want to increase their inventory, and you have countries like China that have committed to building a whole bunch of these reactors, and likely would want to have a strategic reserve of uranium, as what's the point of having a reactor if you don't have uranium? I just think you have a lot of latent buying interest and a lot of just latent demand that's kind of off balance sheet that will be there over time. And my timeline in this is probably 2 years from here. We see MacArthur River, we see Paladin bringing Langer Heinrich on. You have a bunch of these mines restarting. So, it kind of has to happen by 24, at worst 25. But, I kind of think you're going to have the two curves, cross, and you're going to have some sort of crazy blow off move. And remember what I said, that blow off move will be accentuated by whatever Sput and Yellow Cake and some of the other entities do.
Is there I don't know, some historical spread relationship between oil and uranium that suggests that it's oil moves, uranium moves in a similar way? I'm always curious about how cove movements kind of develop on that end.
I don't think they're correlated. I mean, commodity cycles tend to be correlated because, for instance, if you look at oil is correlated with all the other potential products that either get used with oil or can be substituted for oil. And you get these funny correlations, say oil and rubber, for instance, which you would never expect, but they can kind of be substituted in ways for tires. But when it comes to nuclear, once you turn a reactor on, it stays on basically for 40 years or maybe 50 if it gets an extension, and use the same number of pounds each year, and there really should be no correlation. It really just comes down to simple supply and demand, and it's a very consolidated market. I mean, you have a few dozen utilities that have nuclear power plants, and you have about 10 mining companies that produce anything of any scale. It's a really just small market.
All right, so that's on the bullish side. I'm curious your thoughts on where is the market most vulnerable, or maybe where is there still a lot of air to come out? You can argue technology, ARC, FANG, but I kind of feel like it's a little bit long in the tooth in terms of that relative decline. But talk about some of the areas that make you nervous here.
I'm not terribly nervous. I mean, you know, uh, I tend to think that the ARC names, many of them eventually go to zero, but the rate of decline probably stays about the same. I mean, Carvana is down 90%, but it might drop 90% by Christmas still. These sort of things, and there'll be some vicious short squeezes along the way. But I don't short, and I just don't have any view on these sort of things. Like Peloton, like it probably won't exist in 2 years. Someone will just have it in runoff in a private equity shop. But I don't really have any edge in these sort of things, so I kind of leave them alone. I think touching consumer is going to get just annihilated because oil is going higher, and oil is going to drain everyone else's milkshake. And consumer is a fixed cost business with high operating leverage. And when you start comping negative double digits, your economics collapse. So I think that's where I'd look. But look, the market's down 30% already, 25%. A lot of the things I look at, which is the smaller cap sort of companies, the so-called value names, a lot of them are down 75% from the peak in Q3 last year. I mean, a lot of these things trade at single-digit earnings multiples, even if you kind of abuse the earnings number. So I'm not particularly concerned about the stuff we own, and I'm not really concerned about the market. I think the accidents are waiting to happen in the FANGNAM sort of stuff, where you're going to see multiple compression, and I think it's going to be anything touching consumer. If there's a recession, maybe demand goes up, maybe demand goes down. I mean, it's hard to even predict these sort of things. I'm not worried about the speculators selling. I mean, 2 weeks ago, they knocked oil for $10 in a day. It just doesn't really matter to what I'm doing. We own basically oil services stocks. The only way we're going to get ourselves out of this crisis is just a whole lot more drilling and exploration, and that should be good for these guys' businesses. I mostly have offshore, and then I own oil futures options, and call spreads, and a bunch of butterflies and other structures I've built. Because I just think the price is going higher, and I'm not really very fixated on what happens this week or this month. A lot of it's pretty long dated stuff. So I just don't really have anything to say on the short term. And I would look at what's happening in the Commitment of Traders report, and I'd look at what's happening in the open interest of some of the ETFs like XOP or OIH or USO, where you've seen really negligible buildup in speculative demand. I mean, despite everyone saying that they think oil's overowned, and a couple of us on Twitter are probably being a little too boisterous and probably well overdue for a spanking. I don't feel like the rest of the market's long this stuff. If anything, the rest of the market's saying, as soon as oil drops to 80, my stocks go up. I think that's everyone's hope and plan and battle plan. I just got to wait till oil goes back to 80 and then my stuff goes up. And I think that's almost a sense that they've lost the narrative. So, I mean, 2 years ago when the Fed was trying to fight germs with monetary liquidity, I started joking that they had enacted Project Zimbabwe. And that was a bit tongue in cheek. I really hope we don't become Zimbabwe here. The guys running the Fed seem to see that as a role model. But they just, spread a bunch of liquidity everywhere and took rates to zero, and everything went up. And that's what happened in Zimbabwe. Anything with a Q-tip there went up. And my view is that we're almost in an inevitable sort of path higher in asset prices because the debt's too high and they're going to be forced to print, especially because with a 2-year election cycle, no one's willing to take any pain. I mean, we're almost in a weird moment in time right now because Biden's asking J-Pow to raise rates and create a recession so that inflation stops. And Biden doesn't, I guess, realize that there's an election coming up in November. It's like this weird moment in time where you have a senile idiot in charge and you might actually have a recession for once. But I just think there's no willingness to take pain, and the path of least resistance in a democracy is always just to print more money and postpone the election to the next postpone the recession to the next election cycle. And I kind of see us going along that path. And if you look at, Weimar or Zimbabwe, maybe not Zimbabwe, but you look at Weimar, you look at some of these other classic inflationary bust ups, there's moments in time where sane people tried to stop the inflation, and they pulled back on liquidity. They pulled back on fiscal. I mean, we haven't really pulled back on fiscal, but maybe a little. But and then the pain got too great, and the only solution was to print more money. And they just pivoted rapidly back to money printing. And I think we're in one of those weird troughs in Project Zimbabwe where you have a almost preordained path of inflation, yet the government's kind of pulling back for a bit and hoping that they could fix it, and they're going to eventually hit the pain threshold and then liquidity at it. And I just don't know when that pivot's going to be. But today when you look at euro dollar 23s versus 22s, euro dollar market's already pricing in a pivot sometime the next year. And so I think that's really interesting because, it seems almost dumb to have a Federal Reserve. If you look at it, Federal Reserve just tends to lag where the 2-year goes. And so you could probably save the U.S. government, tens of billions of dollars by firing it everywhere at the Federal Reserve and just, watching the 2-year move around. And so, sorry, it's long-winded, but I do think they're going to pivot. It's probably sometime in the fall or winter. And I think what actually gets them to pivot, what no one's really expecting, is that when oil blows off, the Walmarts of the world start crying, and they're almost forced to bail out the rest of the economy because oil is wrecking it. And so, normally, well, for the last couple months, J-Pow's been chasing the price of oil higher. But at some point, he's going to panic and literally have to flood the market with liquidity because of oil.
Well, he's chasing oil higher because oil is so correlated to inflation expectations, right? So,
Right.
I mean that whether you're in oil or in tips, it's all the same trade, right? It's based on oil as the precursor.
Yeah, sure. I mean, not financial advice. Oil is meant for trading. Oil services companies are highly cyclical. Throughout the full cycle, they don't create a lot of value. Oil producers themselves usually destroy value. These are meant for trading. They're really not meant for owning. And kind of this isn't the sort of industry you put it away and forget about it. In terms of oil services, a bunch of them have been beat down in the last couple of weeks. I own a ton of Valaris. It's the largest offshore drilling company. I think that throughout this cycle, offshore drilling capital expenditure sees dramatic increases just because all of the better basins that don't have regulatory and compliance problems tend to be offshore in countries that really need the dollars. And so you're looking at, Guyana and Suriname and Brazil and West Africa. Namibia just found a huge resource that's quite impressive. I think you're going to find much more offshore. And I would think that eventually at the end of this cycle, all the rigs that are still cold stacked end up operating at crazy rates. I mean, there's very few things in this global economy today that haven't taken out the highs in 2008. I mean, crude oil is one of the few that hasn't, and rig rates haven't. If they peaked out last time at 600,000-700,000, I mean, why can't we go to 1 million this cycle? And it gives you a multi-bagger. But once again, these things are meant for trading; they're not meant for owning. But
Appreciate
yeah,
that.
and then in terms of what I do, I mostly just own long dated futures options, call spreads. I mean, you don't have to invest a lot of money to control a lot of barrels of oil,
Right.
and that's just how I'm doing it. And I don't trade these things. Quite honestly, the bid ask spreads are so wide; it'd be insane to trade them, especially when you own thousands of contracts. It's just a question of putting it on and letting it play out. And if I'm wrong, I'll lose my premium, and it'd be expensive, but life goes on.
Let's talk about the trading for a moment. Harris, everyone's got their own favorite set of indicators or tools to determine entry and exit points. I mean, you've got a theme, you've got a catalyst. How do you determine how to weight and how to trade around, volatility?
So I don't trade around volatility that much. I've been long oil. I had this thesis that ESG would create this Lehman sort of moment, and I wrote about it in the fall last year. And in the spring last year, I got long oil producers because I saw what was happening on the demand side, and I saw a zero response on the supply side. You have to remember, since 2014 and even earlier, it was the oil producers that were their own enemy. I mean, they were just producing more oil into a glut. It made no sense, but they had debt covenants and EBITDA covenants. They had to just keep producing, even if it destroyed capital. And so if you had ESG and you had Biden getting in the way of the producers destroying their own capital or their shareholders' capital, you had this impediment to what had held back the price of oil for the last decade. And so it just became obvious to me. And when something becomes obvious, you do a lot of work on it. You develop a thesis. From there, obviously, how you express that view is usually more important than even the thesis itself. And then, I put it on, and for this one, I put it on as a pretty massive position. It was a position max, just because I felt pretty confident in my view. And over time, I adjusted some stuff. Valeris came out of bankruptcy. I thought the price was wrong, so I added some of that, and I sold some Sandridge, which had appreciated like a 10 bagger. um, you move the book around a little bit, but for the most part, I put a trade on and I leave it on. I ignore the volatility. Sometimes at the extremes, on the way down, I'll write a few puts. I get longer if I get assigned, or I'll sell a few calls. If it goes too high in the other direction. But we're talking a few percent around the book. I mean, the core of the theme is to put a position max on, or whatever you want your size to be, right at the point of inflection where you're taking the least amount of risk. Because if you get it wrong, you get your money back. I mean, if you're buying oil here at 110, if you get it wrong, you're not getting your money back. You're going to lose half. So you have a very different risk and reward profile here. Doesn't mean it's not a great investment, but you have a very different risk reward. So I wouldn't be, playing it here. I would have been playing it last year when I was playing it. And then, in terms of when to exit, the market will tell you when to exit. If you start seeing a lot of money thrown at CapEx, that you have about a 2-year window to get out. If you see something dramatically change, you'll know. I mean, I famously made a 6-bagger in Bitcoin. I bought it at 9,200 because Project Zimbabwe, and I know that Bitcoin does well when the Fed floods the market with liquidity. And I sold it when porn stars started pumping shitcoins. When you take financial advice from Mia Khalifa, it's time to get out. And suddenly my whole Twitter feed was people retweeting stuff she was writing about Bitcoin. I just said, this makes no sense. And I sold mine at 58,000. I sold mine about 6 weeks before the top. I missed out on the last 5,000, whatever. I'm damn happy I sold it when I did, though. And it's just funny how things like that work. But there's a certain mass psychology to these sort of things, and the markets will tell you when to get out.
Yeah, no, that point about the Bitcoin and celebrities, it's like, Paris Hilton put laser eyes on, I think it was April of last year. And that was pretty damn close to the top too. Um, I, I am curious your broader thoughts on cryptocurrencies, Bitcoin in particular, from a longer
Uh,
term perspective.
well, I think most of the cryptocurrencies that exist today have no reason that they should exist. They tend to not solve a problem. It's a solution to a non-problem, often involving two other currencies that are trying to solve non-problems. The whole thing's a giant Ponzi scheme. It's insane how much capital has gotten tied up in this thing, and how many truly smart people focus their energy on grifting instead of doing something productive. In terms of the core coins, I have a feeling that we'll be using Bitcoin in some way in financial transactions 10 years from now. it probably happens at a higher price. Not so much because Bitcoin's this great invention. Well, actually, it is, but not just because of Bitcoin. More a function of the Federal Reserve printing a ton of money. I mean, you buy Bitcoin. If you look at the history of Federal Reserve cycles, they basically overstimulate on the way up because everyone's cheering them on. It's a lot of fun to create jobs and be heroes. And then eventually they panic over inflation. They over tighten, they break stuff, and then they overstimulate again to fix their own mistake. Like I said, if you follow the 2 year with like a 6 month lag, you're the Federal Reserve. Um, and so, when they break stuff, I'm going to probably buy some Bitcoin with the full confidence that they're going to overstimulate and flood the market with liquidity again. But that's probably 6 months, a year in the future, whatever. Once again, the market will tell you when it's time. And I think Bitcoin's going lower before it goes higher. And I just I'm not going to tell you I'm a crypto expert, but I think 99.9% of these things won't exist. Sure. In terms of Bitcoin, I think it's going lower. The Federal Reserve is draining liquidity. When they drain liquidity, Bitcoin goes down. Like it's that very simple physics equation with very high correlation. No, I think Bitcoin's going much lower. I don't know if that means 5,000 or 10,000. I don't know. I mean, I have no position either way. Um, so I don't really know. I just think it's going lower because they've told you they intend to break stuff, and they have a long history of breaking stuff, and I take them at their word that they're going to break stuff. And Bitcoin is highly levered beta stuff that they break. In terms of the rest of the market, they've told you they're going to break stuff. I assume they'll succeed at breaking stuff. And yeah, I think the rest of the market goes down too. With very oversold, sentiment's just abysmal right now. I feel like we're overdue for something of a bounce. I'm not really playing it, but I could see us, having a bounce this summer, and the real selling starts in the fall. I feel like guys are still trying to buy bottoms here, and they're not really. You haven't seen the flush yet, but I don't really try to focus on bear markets and finding bottoms in bear markets. I really try to focus on bull markets and riding bull markets. And, even when Bitcoin does bottom, I'm going to wait for it to build a base and a bottom and a definable, entry point. Bitcoin is a chart. That's it. It's an arbitrary price and driven by human emotion. And so let the human motion write me a chart that I know where to get in and get out. I'm not bottom fishing that. God, no.
Yeah, exactly. Do you do any work, Harris, on looking at credit spreads or looking at the bond market to help you decide what to allocate to? Because that's been part of the frustration this year, as we know, is that 60/40 has not exactly been a diversified portfolio.
Well, I mean, I wrote an article last year saying 60/40 was going to blow you up. It seemed pretty obvious 60/40 works during deflation and it destroys capital during inflation. And, I was pretty clear that a lot of the big purveyors of 60/40, especially the leverage ones, are going to go bankrupt. And it seems to be playing out like I expected. I mean, go if you want to see some of my predictions, go to my blog at Adventures in Capitalism. But in terms of credit spreads, I don't really track that. I mean, I don't really track the bond market. I mean, a lot of these things are so over manipulated these days. The Federal Reserve sets the price on any CUSIP they want, and you have like 5 funds that own most of the corporate bonds, and at least the investment grade stuff. Like I just don't think it's as useful as an indicator as it used to be, and so I haven't really spent as much time on that. But once again, I'm not looking at things that are in bear markets. I'm really and trying to buy bottoms. That's how you lose a lot of money. I'm focused on bull markets. I mean, energy, uranium. I think U.S. housing's in a raging bull market, though we're in something of an intermission there. Um, I'm focused on bull markets.
All right, so let's talk about housing because we haven't touched on that, because I think there's a growing drumbeat around the idea that housing is going to decelerate or maybe even outright see some declines. But you're saying you're still bullish on housing, so maybe kind of lay out the argument for property, for real estate as an investment.
Well, if you look at hyperinflationary cycles, and I don't think we're going to go quite hyperinflationary, but we're going to do double digits inflation for a very long period of time. Um, real estate tends to be a great way to preserve wealth, often better than stocks. And your average middle class guy just got burnt in stocks. He's going to go buy a house or buy a second house or a fifth house. because there's always a government program that's designed to subsidize the purchase of a home, especially a new one, as opposed to an existing property. And you can finance this thing even today at 5%, and it's appreciating at 15% or whatever the number is right now. And let's just use round numbers and go with my example. So you're making 1,000 bips spread. You're putting 5 turns of debt on this. You're making 50% on your equity, and then you get a little bit of yield because you have a tenant in there or whatever else. And I mean, why wouldn't you want to make 50% on your money each year when inflation's running at 15? So I think people are going to just keep plowing their money into real estate, much like they have. And as it starts working better, and it's been working quite well, I think you're going to see this all accelerate, especially as the stock market kind of destroys people that were buying, Ponzi stocks and SaaS crap and all this other stuff, and realize they have no idea what they're doing, but they know how to buy a 3-bedroom house in their neighborhood. So I just think you're going to continue to see demand. You have a massive demographic trend. The boomers had the millennials, and the millennials held off having kids for a decade, and now they're all having kids and moving to the suburbs. You have a huge migration. It's almost like a refugee crisis of upper middle class and wealthy that are leaving the high tax states, the Northeast, Illinois, California, and they're all fleeing to Florida and Texas and Tennessee. And you have these huge building booms there, and I think people are getting caught up in this idea that you look at national statistics, they're kind of rolling over. I get it. And then when you look at it on a regional basis, some of the regions are just white hot and some of the regions just completely suck. And, I think people have lost the narrative here because they're lazy and they look at national data. And I'm not, trying to bet on the price of homes because I think that's, hard to play. And I don't have a great view because if they take rates too high, the price of homes will drop. But I have this view that these refugees need to put a roof over their head, and the demand for homes will stay elevated. And I'm not, setting an exact number, but it had been between 6 and 800,000 for a decade. I think we'll stay above a million. And if you stay above a million, companies that I own, like Builders First Source or Louisiana Pacific, that supply into the housing trades, I think they'll do phenomenally well. And they have very, very high returns on capital. They have unique products. They're almost monopoly businesses at this point due to consolidation. And I think the price of lumber stays high. I mean, everyone's talking recession, but lumber's over 600. This is a historically high price for any moment in time, unless you're looking at 2021. And so I just tend to think these businesses earn very, very high returns on capital, and you can buy them at 3 and 4 times earnings. And when you have a business that's growing 10 to 15% a year at 3 times earnings that has a 50% or better return on capital, you close your eyes and you buy it because that's like a world-class, top 1 percentile sort of business. That's better economics than a lot of the SaaS companies. And it's amazing that they're priced where they are. And usually they're priced like that because there's some fatal flaw. And I think the fatal flaw, if I get it wrong, is that demand drops from 1.2 million to 900,000. And it turns out I paid 6 times earnings. I just think, either way, I'm going to make a ton of money. So that's how I'm playing my housing. I think that's the lower risk way to play housing than buying some of the home builders and betting on the gross margins of the home builders or the sell through or any of these other metrics that are hard to predict. And home building is a pretty mediocre 20% return on capital business anyway. If you're going to own something for a cycle, you want to go up market in terms of return on capital.
Other than oil, home builders, uranium, is there anything else that's maybe grabbing your attention that's maybe starting to look interesting as a new theme? I mean, obviously you don't get too cute, right, as far as constantly switching up allocations, but is there anything that's kind of getting your attention more recently? Or
Well, I don't switch allocations very much. I tend to put something on and let it play out unless, it either plays out and I get paid or eventually you realize why your thesis was wrong, And sometimes these play out slower than you expect, but, you stay with it because it's working. And I think one in that regard is there's been a dramatic transition of newspaper companies that had been just really terrible businesses for the last 20 years as the newspaper companies, they're run by journalists. They're not run by business people. They're still not run by business people. But they were literally giving the content away for free on their website and then charging people $50 a month for the print copy. It made no sense. They were competing with themselves. It was the dumbest business model I ever heard. And it's not surprising that their revenues were declining 10% a year for like 20 years in a row. But they finally, New York Times kind of the first to crack the code of improving the technology, using an app instead of the website. Getting people to actually pay you $10 a month to access content, and then targeting the advertising. And the New York Times is obviously a decade ahead of the cycle compared to a bunch of these other guys, but everyone else is figuring it out too. And you have these businesses that are digital native businesses that are growing 30 to 100% a year, and they're at 95, 98 incremental gross margins, and they're just growing fast. And meanwhile, the print business is slowly declining. The decline rates have kind of leveled out at between 1% and 5% a year. And so, as digital got to be more than 30% of business, suddenly the whole enterprise is growing, but it's growing at a much higher return on capital and much higher gross margin. And I got into these all when I have a basket of them. I probably shouldn't name any names, but I got into these right when revenue started growing across the enterprise because digital is growing so fast, and it got to be a big enough piece of the business that it kind of hid the decline of print. And my expectation is print probably doesn't exist in 5 or 10 years for most of these companies. They'll be digital native businesses, probably with a revenue stream that's roughly where we are today. But if you run a print facility, you have dozens of people, you're chopping down trees, you're putting ink on it, you're printing it, you got to deliver it at 5 in the morning. It's just like this terrible capital intensive, people intensive, low margin business. And as they make this transition, the returns on capital will explode. If you look in the 1970s, everyone has this funny chart showing you the best performing assets in the 1970s. It always shows like gold and oil and real estate as being the things you're supposed to own. And I don't know why the chart doesn't show it, but newspaper was the best performing asset. You have monopoly businesses with price power, and during inflation, the velocity of things move around, which means that people spend more money on advertising. Newspapers, because of that pricing power, the ability just to raise the subscription price 25% every year. It actually was the best performing asset, especially because a lot of them had fixed rate debt that was highly levered businesses with fixed rate debt. And I think if you want to make money and you think the 2020s look like the 1970s, and you just buy the thing that did the best back then. So now I own a bunch of newspapers. It had been working for me in Q3, Q4, Q1. A bunch of them kind of pulled back lately in Q2. People are worried about the GDP, the economy. That's fine. Advertising rates will fluctuate quarter to quarter based on the economy. I'm really focused on those subscription revenue dollars, and those subscription revenue dollars are just going parabolic. And I think it's crazy you can buy rapidly growing digital native businesses where you're talking about 40% of revenue, let's say, but 75% of EBITDA being digitally native. You can buy it at 2 times cash flow. It just seems crazy. So that's another place I own a lot, and that one, the trend's working, but not the stock price.
Maybe for the last few minutes here, and everybody that's here, please make sure you follow it, Harris, up top, and hopefully follow me as I keep doing these spaces. Since the point was brought up earlier that you're very good at eviscerating narratives, and I tend to be, I think, of a similar type of way of looking at stories. What narrative is the biggest bullshit today? There's a lot of them, but what's something that to you is like you listen to it and be like, that's just obviously wrong.
Like everything.
Yeah, I know. I'm with you on that. I'm as cynical as it gets when it comes to narratives and categorization, but there's got to be something that for you maybe is really kind of outlandish.
Just everything. I feel like there was a time. I mean, look, I think there's always been like propaganda, and the media is controlled by wealthy people and politicians, and they kind of do their bidding and try to dress up stories to make them seem real. And they used to be like 10%, evasion of the truth, and you try to spin some crook to make him look less crooked. But you keep a balanced center to the whole thing. And now you just read these articles, and there's no bearing whatsoever on what's happening in the real world. And this isn't just like a left versus right. This is just like a truth versus lies sort of thing. And I think they really were just that dumb. And I think that also creates a lot of opportunity because the vast majority of people aren't very smart, and that means like half of them are stupider than the average guy. So that just creates a lot of opportunity for guys like us that are willing to think stuff through.
No, and I think it's always good to be skeptical of narratives, and narratives always follow price, right? So it's always after the fact that you see what the story and the reason is. The key is to have the imagination to figure out what the next narrative is going to be. Right? I think that's sort of the proper way to frame it. Everybody's here at the top of the hour. Special thanks to Harris Kupperman as the guest for the hour. Hopefully worth the conversation, the time here. Again, I will have this as an edited YouTube video probably in a week or so. Harris, first time you and I are talking, I largely stayed quiet, but there's a lot that you said that I agree with, and I think we, like I said, share the common sarcastic view of this business. So hopefully we'll do this again soon. And thank you, everybody. Enjoy the rest of your day.
Yeah, hey, let me just, but before we hop, appreciate you having me on. I just kind of want to plug, if you want to follow me, go to Adventures in Capitalism, which is my blog. It's free. You get what you pay for, which may not be much value. And go to kedm.com and take a free trial. We're offering 1 month free trials of the event-driven monitor. It's dramatically changed how I identify opportunities, and I write usually a few pages of macro and themes and ideas each week as well. So got to get my infomercial in. Sorry.
Yeah, no, totally. No, very good. All right, thank you, everybody. Certainly
Thanks,
appreciate it.
guys.